Hey everyone, welcome back to another podcast episode. Chris Lopez here, and today we're going to be doing a deal analysis, and this one definitely is a little bit more unique than a lot of deals we talk about. So this is actually a client of ours who is an out of country investor. He owns a few rental properties here in Denver, sold one, and was doing a 1031 exchange to trade up from a single family to a multifamily. He reached out to us with a few weeks left on his 1031 timeline to help him find a deal. So we're going to walk through the deal itself, which ends up being a duplex on the west side of town, but also talk about all the interesting nuances of doing 1031 while you're out of country during the COVID pandemic. And so my co-host today is Scott Kimball. Scott, how's it going?
Good, Chris. How you doing?
Doing great. So I think this is your first podcast, right? For on the Denver real estate investing, right, Scott?
It is, yeah.
All right.
Yeah.
So for those who don't know Scott, I've mentioned him on a few podcasts. I've known Scott for a few years now, just through YourCast. We've both been, agents, investors, and as we expanded and grew in the Envision Advisors, he was just obviously a perfect fit for what we do. We just share similarities in how we invest, we approach clients. So just, a great team member, and he's the one that actually put this deal together and was able to juggle everything. So Scott, I gave the quick overview. Any other high-level details we should talk about in terms of setting this whole deal up with the backstory?
Yeah. So we were contacted, I know, with our client. He lives overseas because of COVID. He wasn't able to travel back. So he was coming down to the end of his 1031 identification period. So he was really under the gun to find a property.
And what's the identification period? How many days is that from when he sold the property?
So from the time you sell, you have 60 days to identify your replacement property. So he relinquished his property.
It's 45, right?
I'm sorry, 45. Yeah. Sorry. So 45 days to identify your relinquished property, and then you have 6 months then to close it. So
it really just kind of an interesting chain of events here, because this is actually a gentleman I met. The property he sold is one actually Charles Roberts, who is both mentors and friends of Scott and mine, helped him buy I think 5 or 6 years ago. A 3-bedroom, 2-bathroom condo in Aurora, and he sold it I think back in probably July. Yeah, I think right around early July, late July. Yeah, early July, I believe was the time frame, around July 4th. And just coincidentally enough, we sell a property on the market. It's a good rental. And so actually, one of our clients actually was on the buy side of there, and halfway through the transaction realized that he was a seller, and we had met for coffee a couple years before. So, hey, great, great to do a deal with you. Yep. And then a couple weeks later, he was unable to get his 1031 going as planned. And then he reached back out to us to help him, and that's where we started working with him. And they're like, "Oh man, we got I think about 2 weeks, because I think it was right around like mid to late August was the end of his ID window, right?"
Correct.
Okay.
Correct.
So yeah, you guys, this is mid to late August, so during the pandemic, not the worst of it, but also during a pandemic. So that kind of sets you up there. So it's a very very interesting how small the world is. And so Scott, when he came to you and started talking to us, what was he looking to do in terms of just why was he trading up, and what was he looking to get to in his replacement property?
So he was looking for, he had sold a smaller condo townhome unit, wanted to scale up to a bigger multifamily. So he was looking for a property in kind of that 6% cap rate or higher in the metro area, in a good area. And then something that cash flowed, but had some unique situations because he was a overseas investor.
So talk about that, because that definitely changes for some tax potential,
yep.
Or tax liability potential, and also some lending issues. So kind of what are those considerations for out of country investors?
Yeah. So one of his obstacles that he had was in lending, because it is harder for overseas investors to get financing. He did have a lender set up, but to give him more options, we introduced him to another lender that I've used in the past, and that lender was able to give him some better terms on his lending, and then they were able to help us close the deal. So
great, and we'll talk more about financing. When we get to later in the deal announcement. That's one of the big hurdles, especially for out-of-country investors. Is financing is very difficult. So let's talk about the property because I mean, finding a 6% cap rate property in Denver this year is, they're getting harder and harder to find. Or actually using real underwriting.
Yep.
So what did you guys end up finding? Because you went under contract. Give us the lay of land for property, location. Just kind of talk us through the property that you guys found.
Yeah, so we had the search. So he had property managers already in place from his previous rentals. And he wanted to be in the 6-county Denver area. So we set up you find a lot of your searches for our clients and stuff. It's just on the MLS. So that's where we found this. We set it up. We were looking for something that had 3 bedrooms or more. And he wanted to keep it under 600,000.
So I even finding duplexes this is a 3-bedroom 2-bath those are even more rare because a lot of duplexes are 2-1s or 2-1.5. So
Yep.
a 3-2 duplex is great. And so is this a side-by-side duplex?
It is a side-by-side duplex, yeah, and it had a great finished basement. So the square footage on this, so there was...
So each side had a finished basement?
Each side had a finished basement, and
was there a garage?
The 3 bedrooms are on the main level, and there was a garage in the back for 1 unit.
Okay.
So, yeah.
And so this was listed right around $590, and this was up in, you said, right around, the Wheat Ridge, Denver border?
Correct, yeah, kind of Denver, Westminster. It was also, just by Hidden Lake up there.
Okay,
so,
by Hidden Lake, so 72nd near Sheridan and Federal area for...
Exactly.
For those who didn't know the street. So it was listed around $590. You guys end up getting around $570.
Yeah.
So what's the story there? Because that's a pretty good price difference between the list price and what we got it for.
Yeah. So it had been on the market for a while. And so we came in at a lower price. I called the listing agent. Always do that to get the backstory of, and he actually was the owner. And so he wanted to sell it, but at the same time, he had 2 good renters. One unit was empty, and he just filled it with a new renter. And so now there was another lease in place. I think he was getting frustrated with COVID, and he wasn't getting, it was just coordinating it with the tenants, and he was getting ready to take it off the market too. So I got all that story just from visiting with him. And
let me interject here because this is something that we always talk about, something we always do. It's hey, because we, comparing industry stats, we get more properties under contract than averages for realtors around town, and that's a big reason. Is we always pick up the phone and we talk to their agent to get the complete picture.
Yep.
There's a big difference, Scott. You've been on both sides of the transaction numerous times. It's hey, an offer with no relationship versus hey, you've had a phone call or two, an email or two, and then an offer comes in. The relationship matters.
It's huge, yeah. When I'm on the flip side and I'm listing a property, I've had blind offers where nobody shows it and an offer comes into my email box. I don't know who this agent is. I don't know who the buyer is. I don't know if he's qualified. So taking those extra steps just to, number one, let them know and establish that relationship, but also just to let them know that you got a solid buyer because all the buyers we bring are pre-approved and they're good to go. And I think that just comes with our reputation too as agents. So.
All right, so let's talk about the offer process. So we got under asking price, went under contract. So you got under contract, about 10 days before that 45-day ID window or so, if I recall correctly, a week and a half or so?
Correct, yeah, about 10 days.
Okay.
Yep.
So, ideally, in the perfect world, what we do is, we can go under contract on a property well before we're near that 45 ID deadline, and then get through the inspection, because that's where most deals blow up at. And if it doesn't make sense, we have time to terminate and go out there and, find another property and repeat so we can meet that 45-day deadline. In this case, we were running tight deadlines here. So what was the strategy there with the deadlines as best you could with the situation?
Yeah, well, at this point, we were late in the game, so there were no other options. So, we had to make sure that this was viable right from the get-go. Obviously, you don't know what else is out there until you do the inspection. But at the same time, at this point, it was either this or, if he wasn't able to 1031 the property, then he would have had that tax liability.
So you got under contract, and I know you guys did the inspection as soon as possible.
Correct. Yeah.
So what did the inspection report come back, and what was the resolution like?
Yeah, so it came back with some, there was a deck off the back side that definitely was neglected. The inside, the bones were good. There were some structural issues that the seller disclosed. So we were able to bring in the structural engineer and recertify that there were no issues, that what they saw.
Yeah, dive into this, because this is, the foundation's always, potentially big red flags. So talk about that and what the engineer did and gave you guys.
Yeah. So it actually wasn't the foundation that was the issue. It was the structural was more on the roof. So this was a modular building that had been built. A prefab building that's typically built off-site. They bring it in, they piece it together. So there were some concerns about how the two units were stitched together, and that's where the structural engineer came in, basically gave his stamp and said that it was not a concern. So.
Okay, because for modular homes, I mean, these are literally built in factories or hangars somewhere, shipped on a few 18-wheelers, and then brought on site, put on the foundation, and just, I guess, bolted together, piece 1 to piece 2 to piece 3, and that's basically how they're built.
Exactly, yeah. They'll bring in a crane, set them on the foundation. All of the internal wiring, for the most part, is already stitched in. Sometimes they have the appliances and the carpet, and everything's already put together. So then they have to put it together. So, but the buyer worked with the structural engineer, and once they got that buy off, then the buyer was more comfortable moving forward.
All right. So able to get past that, and I think you negotiated some repairs and also got about $5,500 in concessions, right?
Correct. Yeah, that was the deck. There was also some minor issues in the basement, and then also radon issue. So.
And so let's talk about financing here, because we're going to plug these numbers in a spreadsheet. But since he's a foreign national, it's a totally different lending world than what you and I and most of our listeners get. They generally can't do a 30-year conventional mortgage.
Yep.
We've never had success in the past. A lot of times they have to work with a local bank, a First Bank, a Westera, the local banks here. And a lot of times when I've had investors reach out, they're looking anywhere from like a 35 to 50% down payment for them to lend on a foreign national. So to kind of walk us through the process you guys did and the financing that you were able to help piece together there.
Yeah, so I mean, like you mentioned, traditionally, if you have local investors that are U.S. citizens, we get the access to Freddie and Fannie kind of loans, and so we can go as low as 15% in some instances. Typical investors will do 20 to 25%, but in this case, the investor had to go, I believe, 35 or 40% or more up front. But because they were rolling a lot of that money forward from their 1031 proceeds, they were able to cover that.
Great. So we'll talk about the terms of the next one, because now we're looking at the spreadsheet, and we'll give you the high-level numbers. If you want to see this, click on the show notes. It's in the blog post, or, of course, email Scott or email me. We can send you the spreadsheet and talk numbers. But ended up putting 43% down, which came to be about $242,000 on a 15-year note at 3 3/8. So a larger down payment, but those terms, that interest rate is actually a lot lower than I expected for foreign national. Mm-hmm. So I'm guessing because the higher down payment and the shorter note gave them some favorable rates. What did the lenders say about this? Do you remember what options they were presented there and kind of?
Yeah, because he got down about, I think it was another quarter to a half point, because he went to that 15-year note.
Oh, okay, so about a quarter to half point, it dropped that much?
Yeah, I think it was like 3.75, if I remember right. So so he wanted to pay down and get that shorter term. So
that matched up for his longer term financial goals, right?
Exactly.
Yeah. All right. So all in for total initial investment was about $250,000. 43% down payment, about $10,000 in acquisition cost. What about initial repairs? Did he have to do the initial repairs, or was that taken care of through the concessions?
Yeah.
And okay.
Yeah.
So
But then there were renters in place too. So one of the good things is that just before he purchased, about 2 weeks before we closed, the previous owner had just brought in new tenants and got him in there for a 12-month lease. So, with COVID and stuff, he didn't want to have the potential to have any of these units empty. So, so that was good.
And so rental income, $2,000 for one unit, $1,800 for both, the other unit, and
Yes.
those were the current renters, right?
Correct.
Okay, I mean, for 3-2 that part of town, $1,800, you could probably imagine when he goes to renew it, he should be able to bump it up a couple $100, most likely.
I would assume, yeah.
So good.
So this time next year.
I mean, that's a nice little,
It'd be another couple thousand a year.
Yeah.
Yep.
So that's an easy play, a year from now. So we plug in our normal assumptions. Yes, for property management, we put 8% in here. We put 5% for repairs and maintenance. So this is something we were talking about before we hit record on here, Scott. A lot of times I like to put things at 8%.
Yep.
And you said this is good at 5% because it was just an overall relatively good interior shape, right? And plus you had some of the bigger items addressed during the inspection period.
Exactly. Yeah, we didn't see anything else there. This was built in 2006, so this wasn't one of those.
So that's not a
40-year-old
multi, yeah.
Yeah. So that it definitely was more updated than some we had seen.
Yeah. So I mean that means a lot less, 30, 40 years less on the plumbing system and sewer system and electrical.
Absolutely.
Okay.
Yeah.
So about $4,300 a year in taxes, $1,300 a year in property insurance. So that's relatively inexpensive.
Yep.
So that's really good. And then really no other expenses. I mean, obviously tenants are paying their Excel bills, probably a little bit more, water, sewer, and trash, but that'll be offset with some utility bill back on top of the rent. So it should be a wash.
Correct.
All right, so getting to the analysis here. So now we're at the next tab in the spreadsheet here. Annual cash flow before taxes. So this is rents minus expenses minus mortgage debt. About $4,800 a year. I mean, on a 15-year note for an out-of-country investor and 1031, I am very happy with those numbers. Is my reaction. What was your reaction and his reaction?
Yeah, no, this is, is a little under what he was looking, his goal was that 6%, but because we only had a couple days to shop, we were probably, within 5 days, we were having to get something under contract. Otherwise, he would have missed that identification period. So
talk about this, because he wanted a 6 cap rate. This is a 5.7 cap rate. This is 0.3 of a point. And this is something that we talk about, but what did you guys talk about? Obviously, it's below his metric.
Yep.
But what was the decision-making process through there?
Well, in the big picture, at this point, we were out of time. So we could have kept looking, but it was the risk-reward, So, yeah, he gave up 0.3%. So that was the risk, but the reward was he didn't have to pay his capital gains taxes, or he's kicking that capital gains tax down the road with his 1031. If you look at this slide too, the big thing there is next to the cap rate is that $32,000 per year is what he's paying on the loan. And at 3%, I'd say 40% of that's going to principal. So a big chunk of his money, it's not cash in his pocket, but it is equity he's building by paying down that loan. So that's a big piece. And, well, you see it there in the red, the debt pay down, $17,000 right there.
Yeah, and so we're looking at the return on investment quadrant here. So we'll read them. So cash flows is saying about $4,800 a year, appreciating about $17,000 a year, and we assumed a 3% appreciation rate, which is very reasonable in the Denver market. That debt paid down is $17,000 a year. And that's two things. He's doing a 15-year note and has a relatively low interest rate. So you pay off your principal a lot faster that way. Yeah.
And this investor, he's a younger investor, so, he doesn't need cash in the pocket today. This is equity he's building for, 10, 15, 20 years down the road when he retires. So.
And it's also about that because, about $5,000 in cash for the day. And we always like to look at the NOI for, if you have it paid off, that's really going to be like your future income of no mortgage after the expenses. And usually this is, we ballpark it should adjust with inflation appropriately. So when it's paid off, he'll be around $32,000 to $33,000 in NOI. Actually higher than that once he bumps up the rents on the other units, so more like $34,000, $35,000 a year. I mean, when that's paid off, are you going to retire off that alone? No, but that's a really good, pillar in your retirement, your cash flow retirement income as well. Like, that's nothing to sneeze at.
Absolutely, yeah. He'll have that 35 to 40,000 a year passive income in 15 years.
So overall, like, very unique property. Not always what we like to do 1031s. We're pretty methodical, as you guys know. So we always like to start the 1031 process before the current property is even listed. Just because that makes things less stressful, allows us to slow things down, which is always a key component to 1031. So very happy that you guys were able to put this together, Scott. I mean, this is a relatively good deal. Client's happy. He avoided probably tens of thousands of dollars in tax liability.
Absolutely, yeah.
But if you guys are thinking about 1031, both Scott and I have, sold and traded up, and it's a strategy that works very well in the Denver market right now. If you think about it, please make sure you talk to one of us before you list the property. That way we can start getting all the dominoes lined up, and we can, just slow things down, because it's really planning on this stuff makes life easier and everyone's stress level a few notches down on the stress meter.
Absolutely, yeah. No, it's I did over this last year. I've been involved in 4 1031s, 1 reverse 1031. So yeah, you definitely want to be working with people who are in the business, and it is a 45-day identification. So yeah, no, this was a fun deal, fun client, and we were excited to help them.
All right, so Scott, thanks for taking time out of your day to come join us. And listeners out there, if you get any questions on here, email me or email Scott. You can just scott@envisionrea.com. His information's in the show notes as well. But again, if you guys have questions on this deal or just trying to plan out your whole 1031 exchange process, reach out to us. This is the things that we really enjoy on, and it's a huge wealth multiplier. So reach out, we'll help you all figure out all the details.
Great.
Thanks a lot, Scott.
Yeah, thanks, Chris. Appreciate it.